Hey everyone, welcome to a very special episode of In the Money with Amber Kanwar. We are unpacking what the election results mean for your money. The Liberals were granted a fourth term in office under newly elected Prime Minister Mark Carney. Now, it's pretty stunning when you consider that just a couple of months ago, the Conservatives were projected to win by a landslide. Now, this might not be the result that Bay Street was looking for, but on the show, we've got Francis Horodelski, who says there's plenty of reasons to be optimistic about the Canadian markets. Then we're going to speak with Jim Thorne of Wellington-Altus, who says, regardless of your view, Mark Carney is the person you want in the room to deal with the challenges that Canada is currently facing. And there's perhaps no sector with more at stake when it comes to the election results than the energy sector. We've got Eric Nuttall of 9 Point on the show to tell us what he's doing with his energy stocks. Spoiler, he's been reducing his oil exposure. It's an all-star lineup. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. If you're looking to build a portfolio based on in-depth analysis and long-term strategy, you understand the power of informed decisions. With BMO Investor Line, you get access to a wealth of research, market insights, and educational resources, including the BMO Investment Learning Center. Open a new BMO Investor Line account and you could receive up to $3,500 cash back. It's a great way to jumpstart your investment plan. Learn more at bmo.com/online investing. Francis Horodelski, thank you so much for joining me in studio.
Always good to be here.
I think I found now 3 reasons to bring you back, right? This is your 3rd time on the podcast. You're our most frequent guest. And I had to bring you back for the election, probably one of the most historic in our lifetime. I don't know about yours. This has been a little bit longer than mine. But now we have the results. It's going to be a Liberal minority under Mark Carney. What are your thoughts around this?
Well, a couple of things. I guess it is a minority right now, 169 seats. There is some speculation maybe that maybe somebody will cross the floor. That would be interesting dynamics. I've just sort of seen that in the wind a little bit. That would be interesting just to bring them to 172 or 173 from different parties. We'll see if that happens. But minority governments are tough, especially with an unseasoned politician. And maybe that's not fair to Mark Carney because being head of 2 central banks, you do have to be political to some extent. But there's a lot of angst on Bay Street, I would say, more so than in other parts of the country. And I know on the energy side in particular, there's a lot of worry about emission controls and, will pipelines be able to get built or not? How all of that's going to unfold. And, it just feels a little bit like a pendulum swinging a lot. I'm maybe naive and
the pendulum has been there already. The pendulum hasn't swung. It's been with Liberals for 10 years.
Exactly. And that's fair. And he's a Liberal, and the Liberal Party and a lot of the same people are still in power. So that's interesting. But I did see a quote the other day that I thought I really liked, and it's from somebody who believes they might be naive or they might be hopeful or whatever. And I like this. It's remarkable what you can achieve if you don't care who gets the credit. Now, there are a lot of the policy platforms of the Conservative Party that I think a lot of people like, and I think even Carney likes. He stole a lot of things during the election campaign. And if he can steal more of those things and give credit to where credit's due, maybe, I think it's going to be an interesting dynamic. I'm obviously more hopeful than most people. And I like Canada. I think there's opportunity here.
To your point about energy sector, there were so many people, including Eric Nuttall, who's on the show, who said, this is going to be potentially very bad for energy sector. And then in the reaction after was just like another ho-hum day on Bay Street for energy stocks. And maybe that's because you kind of already know what that operating environment was. So like maybe there was some upside under Polyev, but in the initial aftermath of Carney, at the very least, there's no downside.
Yeah, I think that's fair. And I think the companies themselves are, working at self-help initiatives on an ongoing basis. So trying to keep their costs down, trying to manage, the flow of the commodity across the country or to the United States. And they're in much better shape than they have been fundamentally, than they have been probably in decades. And if we can keep the price of even Western Canadian Select up a little bit, and that's going to follow to some extent what goes on in the U.S. And I think the U.S. is probably better shape in the oil patch than maybe some other people. So generally, I'm like a crazy optimistic person.
Well, that's good. I think optimists make the most amount of money. Let's talk about what this means broadly for the key issue of the moment, which is tariffs, right? So now you're going to have a situation where it's Carney and Trump discussing, the fate of that. And is Canada going to be, I've used this word, is Canada going to be under the umbrella with the U.S. or are we going to be on the outside? Like Carney has used words like that have suggested that's a permanently damaged relationship now.
And I hope, again, that the discussions go behind closed doors, which is not happening anywhere in the world, it seems, although the Europeans are playing it a little closer to the vest. We've seen some rollback on the auto tariff side, not layering tariffs. It's going to be a battle, and it's not going to be a battle that's over, by July 4th or whatever. So it's just going to be how we swing with the punches. And I think Carney will be a good negotiator, or his team will be a good negotiator. And just before, I think Carney will be able to look Donald Trump in the eye. And if he does it well, I think Trump, who doesn't respect anybody, almost anybody, might respect him more, certainly more than Justin Trudeau. And I don't know even if he would have respected Pierre Poilievre. I don't know.
I mean, that remains unclear. There was a lot. I mean, Trump explicitly said, I think in interviews before the election, that he prefers Mark Carney. So,
election interference.
Yes. Yeah. Well, I feel like we're way past blowing through all the mores that we're used to. You said something interesting about you like the Canadian markets here. And I find that interesting in the context of both economies seem headed for trouble. The U.S. economy shrank for the first time since 2022. The Canadian economic GDP was also weaker, signaling contraction there, at the very least missing some forecasts. So, that's a difficult environment to be positive in general. Why do you skew more towards the Canadian markets?
Well, there's a bunch of reasons. One, I think the globe is skewing towards Canada. I mean, we've talked ad nauseum about the flow of funds out of the U.S., whether it's the bonds, whether it's the stock market. And maybe that was overblown 2 weeks ago. But I think there's a sense globally that investors don't want to have all their eggs in the American basket. And we're such a small market that any incremental flows to us is a positive. So that's number one. And we've seen that already. We've seen some positive flows. Two, even for Americans thinking about coming north, and I'm not talking about taking over our assets, I'm talking just about investing in our country, they get a 40% bonus every time they come here. And because of the currency at $1.40, $1.37, $1.38, that's the way they look at it. And that's a real opportunity. I think we're one of the cheapest currencies in the world. I've said it numerous times.
You have said it, and I want to give you credit for saying that, because you came on the pod, it was January or early February, and you said about, that Canadian dollar, it is just so cheap. And the U.S. dollar has done poorly against almost everything, but it has rallied against.
It has, and about a nickel, maybe a bit more.
The Canadian dollar. And so the question is, do you see that continuing, and what gets you there?
And I see it continuing in bumps and grinds. So you're going to have to see a lot of things. You're going to have to see Carney not totally misstepping over the next 6 months. You have to continue to see some trends away from the U.S. dollar. And it probably is overshot here over the short term.
And I want to talk about like how defiant it seems that the Canadian dollar is rallying, because oil prices are falling and are falling, and our rates are falling faster too. And those two things should be weaker loonie, but it's not happening.
So, and our rates are, the differential between Canada and the U.S. has widened in their favor. But the rest of the world, not so much. So there's some opportunity even on the interest rate side.
Did you say parity, like the U.S. CAD dollar?
Ultimately, I mean, I'll go there ultimately, but
I don't even know.
You have to have a stronger Canadian economy. You have to have a lot of the things that everybody's complained about solved. Cross-province trade. We have to encourage investment in the country. We also have to encourage, pension plan, and not mandating pension plans to invest in Canada. That's another thing I mentioned a couple of months ago. Investing in Canada more, encouraging R&D, all of the things that people talk about that are good for Canada.
So you like the value that you see in the TSX right now. What's most exciting to you?
Well, see, that's the problem. It's really, really hard to find things. I mean, to be truthful, I'm trading around the edges. So, something I buy, it collapses 10%, I buy it, and then it rallies 10% and I sell it. I mean, I just don't have
conviction.
Yes.
So what do you think the turnaround point, like what do you need to see to go back to the U.S.? And maybe this is part of like a fallacy I have. Like I've just been so addicted to U.S. exceptionalism that I think at some point that comes back. Does it come back? And like, what do you think are the steps to get there? Because if we think about midterm elections in the U.S., like Trump can't go on what's happening now. Well, yeah, you could cancel it. Assuming he doesn't, Trump can't, I presume, like go to the polls with this kind of record.
Yeah, so I wanted actually to start today with, I listened to an interview with the CEO of Starbucks this morning.
Brian Niccol.
Yeah, stocks imploding. It's down 10%, or it was this morning. And he said something really interesting, and people forget this. On the call last night, he talked about EPS. He wasn't excited about where EPS, earnings per share, were going over the next 6 months or 9 months. And the street got all antsy about that. Oh, earnings. And he said, earnings are a result of everything you do up on the income statement. It's investing in the future. It's reducing your costs. It's expanding in a smart way. And ultimately, when you get all of that right, it falls out in the earnings per share. And that's kind of, and I'm not a defender of the way the Americans are going about what they're doing, but that's what they're doing. They're breaking everything above the earnings per share line,
GDP,
which is GDP, and they are, as I said, maybe doing it the wrong way, but maybe they needed to do some of that stuff. So, in the end, I think tariffs are not the right tool to use to beat up the rest of the world to invest in America, but maybe there will be more investing in America. Maybe there will be a lower cost structure in the government. Maybe there will be a better government balance sheet and reduced interest expense.
But Canada can do that too.
Of course we can. And that, in a good environment with the right people in place, and the right policies, sure, why not? But most countries around the world can do that too. I mean, there's too much debt around the world, government debt. There's not a lot of innovation around the world. And a lot of the world has piggybacked on American innovation or stolen it.
Yeah.
And that's actually going to be one of the benefits, I think, as America focuses, or Mr. Trump focuses on reducing investments in, in colleges and in various state departments, I think a lot of that's going to go around the world, and the rest of the world is going to benefit from that. America's so far advanced in many things that it's not going to cut them off at the knees.
I mean, because you're such an optimist, like those are all things that Canada could potentially leverage. Like you talk about university education, like we have that in spades, right? We just don't do a good job of monetizing whatever comes out of those institutions or keeping it within our borders before sending it to the U.S. to be monetized.
Yeah, absolutely. Absolutely. I think we can do that. I mean, but we're a small country. We're 40 million people. America's 360 million people. Immigration's being curtailed. I mean, there are a lot of things. I don't want to be a Pollyanna, which I am always anyway, but there's a lot of work to be done.
All right. Well, end on that note. Frances Horodelski, thank you so much. Coming up next, we've got Jim Thorne of Wellington-Altus joining us. Regardless of what Bay Street wanted, Jim Thorne says Mark Carney is the person you want in the room to deal with the challenges that Canada is facing. But ahead of that, we're going to hear from the CEO of Raymond James Canada. Jamie Coulter joins me. Now, Raymond James, you might think of as an American company, but as he told me, they've got deep roots in Canada. So Raymond James, we think of, it's an American company, but it's actually been in Canada for 25 years. This is coming at a time where there are big questions about the relationship between Canada and the U.S. right now. So how do you, as an operator, deal with those tensions?
I'm glad you brought that up. We are, and I'm very proud to say this, in our third decade serving Canadians as Raymond James. We can actually stretch our history back 100 years in Canada directly to 1924. And one J.L. Godin Company was founded. And in fact, two of his direct descendants are advisors with our firm today. And through the combination with 3Max in 2016, we can actually push our history back to 1849. So that's pre-Confederation. So we've had a long time here in Canada. We're now 2,000 associates coast to coast and working with Canadians in both private client part of the business as well as the capital markets part of the business.
How is the Canadian market different, and what kind of growth does Raymond James see here?
The main focus for us really since 2001 has been on the private client part of the business. And so I think at the time when Raymond James came into Canada, we had about $6 billion in AUA, and we're close to 90 today. We're serving over 100,000 Canadians on the retail side of the business. And so we continue to invest in that private client part in particular. So that's investing in our advisors, the practice management programs, in our branches, and in our platform. We've got a couple of massive technology programs that we're about to deploy in Canada over the next couple of years that will set us up, I think, for the next couple of decades.
Jim Thorne of Wellington-Altus, thanks so much for joining me.
Nice to see you. Long time no see.
Long time, and I had to bring you in when we got the results of the Canadian election because what a wild time. 4 months ago, we were looking at, potentially a conservative majority. Now we know that the Liberals have won, and it's Prime Minister Mark Carney. And I think it's fair to say that business maybe wanted a different outcome. What do you think?
Well, that's a tough question because, I was in the States. I lived in Washington, D.C. during the global financial crisis. And he was a superstar.
Mark Carney.
Mark Carney was during the global financial crisis. It's funny because I say to some people, Ben Bernanke got the Nobel Prize for what he did during the financial crisis. And half of that Nobel Prize should have gone to Carney because he was that important. But true Canadian fashion, what do? We downplayed and discounted. So as where we are in the global economy to represent Canada, right? I mean, chairman of Brookfield, Goldman Sachs, PhD of Oxford, head of the Bank of England during Brexit, head of the Bank of Canada during the financial crisis. He is somebody that you would want in the room to help structurally adjust Canada and the global economy. So for that, I am very comfortable with him. What I am not comfortable with is the fact that Canadians I don't think we're going to be able to absorb another 4 years of Trudeau-type policies, economic policies, not embracing our natural resources, not understanding that that's our competitive advantage. Mr. Carney has to understand that Wall Street and Bay Street abandoned his net zero initiative. So I think the proof isn't going to be in the pudding. And what does he do? Is he, as he says, he's not Justin Trudeau? What are his policies going to be? And the last thing I would say to you, when he announced his economic platform, there was a visceral response from Wall Street and Bay Street because it was 4 more years of Trudeau. He's a really smart guy. He saw the response. So it really comes down to what does he do? And it's a minority government. So am I surprised? No. Am I comfortable with him? Yes. Am I worried about him embracing the Trudeau legacy? Of course, because it's a known unknown, and we're about to find out.
I think that's good perspective. And the reason I said, businesses, maybe this wasn't necessarily the outcome. I mean, there were op-eds that were put out by CEOs across this country calling for conservatives. But then I also remember this moment on the campaign trail where a reporter asked Carney, why didn't he run as a conservative? Because if you look at the policies, he did ultimately scrap the carbon tax. He did abandon the increase in capital gains tax. And he has now called, Mr. Green Energy has now called for Canada to be an energy superpower. To your point, are you willing to give him the benefit of the doubt that he can kind of be the leader that this economy needs to get a jolt? Because when people talk about abandoning the last 10 years, what they're really saying is Canada hasn't kept up. Our GDP per capita has not advanced the way that it has in the U.S., and that's something that people would like to see changed.
I'm going to steal a comment that my daughters used to say to me, two things can be right at the same time, right? So can we become what I would call it as a hard power in energy and natural resources, which we should be, which is what we're good at? Can we exploit that and position Canada for the new AI economy? And it's dependent on cheap, secure energy and electricity that drives AI. Can we do that and at the same time have an eye on the environment? Can we do both? And I think what we observed with the Trudeau government is there was just a focus on the environment. And to your point, the standard of living in Canada is dropped. I mean, Canadians have lived off of the glory of the global financial years and the urbanization of China. That's over. So we need to structurally adjust. The United States needs to structurally adjust. How are we going to do it? And that's where we are. And so once you understand that narrative, you can start to build portfolios and try to figure out what you want to do in investments.
Well, let's talk about that because you're interesting for a lot of different reasons. You're known on Twitter or X as Dr. J Strategy because you do have your doctorate and you've thought about the markets kind of at that cerebral level, but now you also work in finance and you have cross-border experience. You're Canadian, right?
I'm Canadian, yes.
But you spent many years in the U.S. and this election, the results are coming at a time where the relationship between Canada and the U.S. has never been worse. So the fact that the ink isn't even dry really on the election results, what are you hearing maybe from U.S. counterparts? Or how do you think about that as somebody who has spent time on both sides of the border?
So let's go back to the beginning. We'll use and Secretary. If there is one individual for Canada, it would be Mr. Carney. And the Secretary of the Treasury, Scott Bessent, is the guy you would want, the adult in the room, to help in this process. He worked for George Soros. He attacked the Bank of England or the PEG with George Soros, one of the most famous macro trades in history. He taught history of economic thought at Yale. So what I'm trying to say to you, Amber, these guys are really smart. So let's go and everything that I'm going to talk about, they know. Okay? So you go back to Bretton Woods, which was the last time we had a big structural adjustment. Keynes warned the Americans that if you use your currency as the medium of exchange of the global economy, countries are going to devalue their currencies against yours. You're going to go from a debtor nation to a creditor nation. You're going to go from a manufacturer to a consumer. Your standard of living is going to fall. You're going to get the rise of populism. Okay? The response to that was the World Bank and the IMF were supposed to focus and help the world globally change, structurally change. And they dropped the ball. There was mission creep.
And in fact, Scott Bessent talks about this
you
in his
just took
most
the words
recent-
right out of my mouth.
Yeah.
Yes. So you're sitting there going, okay. So the Americans have to change. And Bessent talked about this in his confirmation hearing. When interest rates on the debt got greater than the expenditures on military, that's typically in history when empires fail. American Empire, British Empire, and so the Americans have to change, right? And China has to change. China was accepted into the World Trade Organization, and they still have a developing nation status. So they have different rules than everybody else, and they have excess capacity, and they need to adjust. So we're at this point where Trump is the forcing function.
So my question is, and we'll talk about where Canada fits in that in a second, but because you're such a big thinker about these sort of things, is what do you think that reorientation looks like 5 years from now?
Well, there's hints all over the place. So let's use one hint. So Apple is changing its production of iPhones from China to India, and that production is going to be shifted. Those are going to be phones sold in the United States.
Which, by the way, that's just shifting from one low-cost market to another low-cost market.
Exactly. So you're seeing where I'm going. So let's be honest. The United States is not going to become a manufacturing superpower. Does Trump know that?
Do you think in the back of his mind he knows that? Because that's sort of the thing that doesn't make sense.
Well, this is where the big argument comes from, right? Because I'm of the view that you cannot become the president of the United States and not be a very smart man. Okay? And I talk to a lot of people that say this guy doesn't know what he's doing, right? Very quickly, I think what Trump has done is front-end loaded the pain and the insanity in his administration, because really what's important is the midterm elections, and he wants to basically have the economy humming and the stock market humming going into October of next year. And he's willing to take the pain now. So I think he knows exactly what he's doing. Okay. And now going back to behavioral finance, I might be wrong, but what Kahneman and Tversky talked about in their white paper way back in the 80s was you have to have a narrative. So you might say I'm wrong, Jim, I don't agree. Okay, we have to have a narrative, whatever it is, right? And so my narrative is he knows what he's doing. My narrative is Canada has made a decision, a very unique decision in this very historic period of time in history. We are willing to ignore past norms in terms of kicking out political parties, and we're champion Mark Carney. We're going to give him a shot to fix this and to help negotiate our new positioning with the United States in the global economy. The United States is not going to become a global manufacturing power, but they are going to onshore critical components of the supply chain. Amber, the big thing we learned through COVID was that we didn't have the supply chain here. So what are the critical components? Are they in the auto industry? Engines, differentials, transmissions? What are the critical components in semiconductors, in healthcare? I think when you look at it that way, we're going to have those critical components in North America. North America.
So that's the question. Is Canada in that tent or outside that tent?
Well, there's where the negotiation starts. And I think what's interesting, the way I look at this is, Trump is a deal maker. So yes, I have read his Art of the Deal. So there's a couple of things. And let me go back to grad school, right? And it was very interesting because when I was in grad, I didn't know what the heck was going on, right? I was studying, but one of the interesting stories that happened is that there was this young lady that was getting her PhD done at Queen's, and she was in ABD, all but dissertation, and she came to York to teach. And her father was Ron Enders, who was a U.S. ambassador to Canada. And through that, through social interactions, they came across that, and this was very informal, but the reason why the Reagan and the Americans wanted to negotiate free trade with Mulroney was for a continental energy plan. And it was called the proportionality clause in the free trade agreement. Amber, you know what happened in 2020? It was they didn't renew it. So that was the first time since Mulroney and Reagan had signed a free trade agreement that our country, was free to sell oil and natural gas wherever we wanted.
And what did we do?
And so now here are the things I ask, like, to myself. Does Trump know this? Does he know that their negotiation with Canada last time around was flawed? And why do I say that? It's because, it's weird. I watch C-SPAN a lot, right? And what stuck out to me was the tariffs on aluminum, because it's going to take them out. In the 90s, the Americans had 40. Now they have 4. Quebec has the competitive advantage. It's going to take them 10 years to build a smelter. So what's going on? Why? And you go back, and the Premier of Quebec during question period, it's through an interpreter. So he basically is saying they don't believe the security of our natural resources. They're worried about security. So you're sitting here going, we had the proportionality clause. You were secure. Now you're going through this. What gives? And then you add to that, Mr. Carney in the French debate talked about the fact that we are going to have to negotiate a free trade agreement. Well, true. Premier Smith is right. They need our oil, right? Okay.
Not according to Trump, but okay.
Yeah, but that's facts don't matter to him, right?
Yeah.
Yes. But the interesting thing is where I pivot to is carve-outs, right? Because Trump's going to make a deal. So we've got, and then you read his report of all the countries that came out of the Rose Garden debacle or Liberation Day, and what sticks out is the Quebec language law, and some taxes on the internet. But the other one was our supply chain, our agricultural supply chain, which is code for Quebec dairy and cheese. So you're sitting here going, wow, he's going after Quebec, isn't he? So, and that Carney, everybody has said that that's sacrosanct. Okay, so then what's open? Well, financial institutions, right? Telecommunications, airlines. Now let's think about this.
I want to just pause and underline sort of what you're saying, because I think it's really crucial. So one, energy, that's obvious leverage. Another point of contention could be the way Canada protects dairy. And honestly, that's a whole other show, to the extent that we protect the Canadian dairy producers in this country. And as you said, that has just been viewed as untouchable. And I assume because Carney won largely because he made inroads in Quebec, that he's not about to go and slaughter that. So now you're saying there's 3 other sectors that basically operate as oligopolies.
Sure. And so let's just say this, right? Mr. Carney's not going to give up them. So hypothetically, Mr. Trump would say, so what are you going to give me? Well, okay, let's just think about this, right? This is all hypothetical. Mr. Carney, or Prime Minister Carney, was the head of Brookfield, or chairman of Brookfield.
Yeah.
What was the election issue? Brookfield moving their head office to where? Wall Street. Yeah. Brookfield is now a U.S. financial institution. Think about that for 1 minute. Think about that.
Can you tell me what that, just say it explicitly, just to make sure I'm thinking of it the right way.
Well, Marco Rubio, J.D. Vance, and Mr. Trump want reciprocity in the financial services industry. They've said it. Now, I don't know if it's an off-the-cuff comment, right? But they say it, and it's just like Mr. Trump has made an off-the-cuff comment about the Keystone Pipeline, right? So you're sitting there, they make a comment about reciprocity. We know that the financial institutions up here are protected, specifically the insurance companies and the banks. We just have a major Canadian financial institution going down there. Let's even tie on fentanyl. We know that TD Bank got caught money laundering fentanyl, right? Or allegedly, right? Beautiful PR work by the TD team to deflect that. I would suggest you all banks are doing it. I don't know, right? I'm building a narrative, but I could easily see how they come through Canada through the risk door.
Yeah, well, I mean, I don't want to get into too far down that because there is no proof, but aside from TD, which did certainly run into trouble by U.S. regulators, paid a fine, and they're subject to an asset cap in the U.S. So that's like a definite ding. It sounds like you're maybe engaging in the cockroach theory there.
But you just nailed it, because when we were in the States, the last deal I was involved in was taking out the Prime Trust Company in the United States in Wilmington, Delaware, and it was Wilmington Trust. And if you had wanted your trust domiciled in the United States, but wanted the assets outside of the United States, it was called the Delaware Advantage. Wilmington Trust started out being the DuPont family office. Very early on in our relationship, taking that over, we became the poster child for AML KYC.
Anti-money laundering and know your client.
And we were chatting before, the chairman of the bank was best friends with Warren Buffett. We had Mr. Buffett was the largest shareholder, and we were put in the penalty box for 4 years, no deals. So now think about what you just said to me. Where's the growth in Canadian financial institutions? They over-earn up here and take their capital, and they overpay for financial assets down in the United States. So this could be totally conjecture. I could be 150,000,000% wrong. But as a strategist, what you do is you start with these narratives, and then you basically, this is true, that's false. This is true, that's false. And you continually build the narrative as we move down the road.
So let's talk about what this means then in the portfolio. How convicted are you on that narrative around financials? Are you suggesting that you would avoid the Canadian financial sector right now?
No, I think they're still very well managed. I think their growth, so their dividends are safe. This is about growth, okay? And I think what's going to happen, going back to the United States in the structural adjustments, is Bessent and Trump have talked about deregulating the financial institutions. The Americans need another big purchaser of treasuries. We cannot go through another round of quantitative easing or the central banks purchasing that debt. There is, I think, $10 trillion that needs to be refinanced. Debt to GDP is 125%. They want to go back to pre-Dodd-Frank. They want to go back and allow banks to be able to take all that capital that's at the Fed, and they can trade on their own accord. The fancy term is excluding U.S. Treasuries and near-term cash from the supplementary leverage ratio. If that happens, banks have they become a massive purchaser of U.S. Treasuries, and B, a massive profit line comes back to the banks. So I am very interested in U.S. banks. I think the Canadian banks are going to be fine. I think what you touched on is, what do the Canadian banks need to do so they can come back into the United States and grow their business model?
Right. So you expect growth in the U.S. talk to me just generally about your investing view and whether it changed on the back of the election, Canada versus U.S. markets. Canadian markets have done better in 2025, mainly because we've got gold stocks, but we're also cheaper and we've got higher dividend yields. And right now, there's a little bit of a sell America trade going on.
Yeah, I look at this as pick your decade. It's either the 1950s or the 1990s. And so what we really haven't talked about is the technology wave. AI is a matter of national security for the Americans. They're in an innovative war with the United States, with China. And so I really don't think valuations matter. And this is one of the unique times where valuation doesn't matter because we really don't know what the total addressable market is. So yes, we're going to have a bubble. Okay. Typically what I do is I do a long-term view, but a year view. And I'm very comfortable with the fact that you're going to get quarters or a couple of quarters where there's going to be a catch-up trade. Let's be honest. Canada underperformed historically in the first half of last year. Ever since the Bank of Canada rightly started to cut, Canada has been playing a catch-up trade. And what have you had? You've had the gold stocks. And if you love gold, you have to like Bitcoin. Okay, so gold, I'm very bullish on Bitcoin. I'm very bullish on gold. I think gold's got a little bit ahead of itself. I think Canada is going to do okay if Mr. Carney plays his cards right, but I just don't see the G. I don't see the growth in Canada. Canadians will invest because of the dividends. It will be very interesting to see what happens. We're in a secular growth. We're in a secular bull market because of the demographics. Right? All you have to do is go back and find this big cohort in history that is going into family formation and savings. That's your cohort, right? That's no different than the 90s with the boomers. You invest differently, right? You guys invest. The younger generation likes digital assets. They like ETFs. They do top down. So I am still saying the U.S. over Canada.
Dr. J, thank you so much. Always a pleasure. Thanks so much for joining me.
Thanks a lot for having me.
Coming up next, we've got a deep dive on the energy sector. It's got a lot at stake when it comes to the election. And we're going to be speaking with Eric Nuttall of 9 Point, one of the biggest independent energy investors in this country. And the last time I spoke to him, he said if the Liberals were to win, it would cause him a lot of concern. We're going to find out how much concern and what he's doing in the portfolio next. Eric Nuttall of 9 Point, thanks so much for coming back to the show.
You bet.
You're one of our few repeat guests in our infancy. And of course, we had to bring you back after the election. When me and my girlfriends call each other and do wellness checks, we ask, how are your emotions? So Eric Nuttall, how are your emotions?
I'm coping.
You're coping.
Yeah.
You made no secret of it that you were rooting for Poilievre to win. For the country, I think your views aligned with his, but also in terms of what it meant for the energy sector.
Yeah, it was both. Like, it was a very late night, very early morning. I didn't sleep all that well, but yeah, it's, as a Canadian, as an individual, my own personal views and all that stuff, I thought we had an opportunity. I thought Poilievre was going to be a really transformational prime minister. I really agreed with his agenda. I'm aligned with lower taxes, especially with 53.5% top marginal, and we're told we're still not, donating our fair share and whatnot, the concepts of small government. And then for energy, I really think he would have been the most pro oil and gas prime minister in our history. Like, his views were aligned with mine. I had the opportunity to chat with him a few times in terms of the necessity to build up pipelines, the necessity to eliminate certain existing legislation, which makes that very, very difficult. The industrial carbon tax, how that makes us uncompetitive relative to other jurisdictions. And so my views were very much aligned on him, both in my philosophy on government and, more importantly, on the impact that could have had on oil and gas stocks. Like, we trade still at a political risk discount owing to the past 10 years and potentially the next 4. And I'm let down a little that we missed the opportunity to eliminate that.
So that's interesting you talk about the political discount, because when we spoke at the end of January, it was actually just as Trudeau resigned. Your mood was very different because, to use your words and the polls, we were looking at a conservative landslide before things started to shift with Carney in place. And of course, the Trump 51st state rhetoric did not help the case. You said the day Trudeau resigned, I got inbound from a U.S. entity with billions in capital looking at Canada.
Yes.
So I want to know whatever happened with that, and what conversations have you had since the election, either with company CEOs or potential capital that was looking at Canada's energy sector?
I haven't talked to a lot of people. Like, we're only a day post the election. I wanted to take a day just to let emotions calm down, and you never want to act out of not to say anger, but disappointment, whatever. So much of it today is a to be determined, because I think purposefully details, and I'll speak solely to the energy, details were extremely vague. You know, we were going to be an energy superpower, and then we're going to be a clean energy superpower. We're going to have an energy corridor, fine. That was about it. So in terms of other commitments, like, it was clear, I think, that C-69 is going to remain in place.
This is a bill that effectively they call it the no pipelines
Correct.
bill.
And really, it's not just pipelines, but it's major infrastructure. It's creating so many regulatory hurdles and expenses that a company has to commit to just to get to the point of knowing or not knowing whether a government is going to champion something. And it still gives veto power to the environmental minister. So, you know, there was a pipeline years and years ago, and the CEO said, look, I'd have to spend $300 or $400 million just to get to the point of knowing whether the project would get approved. Like, if I spent that money, my shareholders would kill me. So it's really, it's blocking the ability to get things done in this country. It's like, for a pipeline, a company would have to do a gender-based analysis. So very clearly, it's shades of the past, you know, former prime minister. And so CEOs don't even know what that is, but it's in legislation. So it's just, it's preventing us from building out projects that we desperately need as a country. We've been big advocates for that, but it's just, we don't seem aligned on that.
So you're disappointed, but it sounds like you're still waiting for color on what Canada as an energy superpower actually means. Back in January, you said if Mark Carney were to become prime minister for more than 2 days and the Liberals win, which we had no idea that that's exactly what would happen, that would cause some concern for you.
Sure.
And I want to know how that concern, and it's still early days, shows up in the portfolio.
Yeah, so we have to look at, especially on a campaign trail, what is said versus who the person is that is saying that. And so we spend time, and I wish people spend as much time learning about the platforms of politicians as they do on the Toronto Maple Leafs, because perhaps we'd have a more informed electorate. And so I bought Mark Carney's book, electronic version, so I could do a keyword search, because it's not the most exciting read, 500 pages. But when somebody says that, you know, climate change, we know his views, is the 6th mass extinction event, that the majority of hydrocarbons need to stay in the ground to reach climate goals, when they're talking about publicly, they're on Team Greta Thunberg, et cetera. That's the background. And so when somebody talks about, you know, the necessity to have ongoing carbon taxes on industry, again, we're not going to get rid of C-69, Guilbeault on the campaign trail. So again, it's a campaign trail, but said, you know, they're going to keep on the emissions/production cap. Those are the words and actions so far that don't show that this is a government that's massively supportive of a sector that's 10% of our economy. So to your direct question, how is it reflected? My base case as of now is it's status quo. We've dealt with a government for the past decade that has not been supportive of this group. C-69, tanker ban, anti-greenwashing ban, carbon taxes, emissions production cap, all of these things. And yet we've done fine, and we will continue to do fine. If we cannot grow production because we'll run out of pipeline capacity in 2 to 3 years' time from now, my view still is that the medium to long-term outlook for oil is exceptionally strong, natural gas strong today and tomorrow. So that means that companies will still have very significant revenue. And if they can't spend money on CapEx on drilling more and growing, well, that just increases free cash flow. And we've talked about how this sector has spent the past year and a half deleveraging, paying down debt. The current oil price, average debt to cash flow is about 0.9 times, very, very healthy. They only need $51 WTI to keep production flat, pay the dividend. So we anticipate that the windfall free cash flow will be then put into share buybacks. And so we'll actually have more share buybacks under a Carney government than we would have under a Poilievre government.
The last time you came on, I gave you a hat that said your signature catchphrase,
Sure.
we remain bullish. It sounds like you're still wearing that hat.
Well, we're bullish on energy stocks.
Yeah.
On oil, what's changed is the impact and clarity around tariffs, the likely impact that will have on oil demand. And we're still guessing at this point. Like we have software programs that we subscribe to, very expensive, but very valuable, that show in the month of April, oil demand was up 1.4 million barrels per day, very strong. So it's the anticipation of weakness in the global economy, the U.S. economy, Canadian economy, is not yet reflective. And so it's a fear of what is coming down the pipes. And at the same time, there's been a pivot on the part of key leadership within OPEC Plus, or this voluntary members of this voluntary deal, where there have been chronic cheating on the part of Kazakhstan and some other countries. And so I think the leadership is showing that they do not want to exclusively shoulder the burden anymore. And so at a time of peak uncertainty around demand, not only are they returning barrels as they outlined, but they're actually accelerating the return of that. And so the market's looser, or likely to be looser. We're now at a price. We've gone into a world where I think you've removed the OPEC put, or the perception thereof. You're now in an oil price environment where you have to balance the market through killing supply growth. The marginal barrels, U.S. shale, that's about $60.
So I want to underline that, because you've got two seemingly negative factors. The political scenario, fine, you can call it neutral because it's just sort of status quo, but oil prices around $60 per barrel. How can you be bullish in this environment where we just got a snapshot of both the Canadian and the U.S. economy? The U.S. economy is contracting, outright sort of contraction. That has to weigh on demand, you expect,
Sure.
Going forward. So with those two factors, I want you to clearly spell out, like, what is there beyond, I guess, share buybacks to get excited about in the energy sector?
Yeah, there's 9 to 10% dividend yields that are sustainable down to $50 or lower. Fear creates opportunity, panic creates opportunity, uncertainty creates opportunity. So you can buy companies. We put up graphs, and we're constrained by compliance rules in terms of having tickers available and whatnot. And it's the benefit of hiring somebody to figure it out for you. Shameless plug. But you can buy a company today, a royalty company, paying you 9% dividend, which is sustainable down to $46 WTI. Well, at 46, we're going to lose 1.5 million barrels of shale production. That's equivalent to a 1.5% drop in global GDP. Like, that's super draconian. So there are opportunities. You get buybacks, you get very healthy dividend yields. Capital appreciation down the road, I do think the ongoing impact of meaningful share buybacks will drive strong price performance. For oil stocks, yeah, we're challenged in the short term. It is what it is. So we've cut our exposure to oil pretty significantly. Like, we've got about a 9% cash weight just to be able to ensure that we can handle anything that comes our way.
And what is that relative to history? Like, how defensive is that for you?
Much. Like, we'd have, if we're ultra like hair on fire riding the rocket, we want to have super alpha 2%. You always have to have some cash. You always get typically.
So 9 is high.
You always need to manage redemptions. You always want to ensure that if you hit a liquidity vacuum, and liquidity is tough now. Like, there's an absence of buyers. There's not a lot of sellers, but there's an absence of buyers. So if an unexpected event occurs, you want to ensure, as a fund manager, you always have to make sure you've got a war chest to handle. And so that comes with your view of, okay, what's the risk of that occurring? So we're fine on that. And then we've got about a 70% weight today in natural gas. 65% weight in natural gas. So there's always opportunities. There should be. If there's not, you go to cash. Like, we've been as high as 70% cash in the past, which is ultra defensive and very unique.
When was that?
We've done that 2 times in history. I'd say one was a couple of years ago, and then one was back like 2017. But that's unusual.
That's unusual. And you don't feel like this is an environment where you see those kind of extremes taking place?
God, no. Like, we can discuss, like, natural gas, the thesis has really evolved over the years. Now you've got a massive build out in LNG, that's liquefied natural gas. The U.S. is exporting 16 Bs now. It's up from 14 coming into the year.
That's billion cubic feet. Yeah.
So put that into context, let's say the U.S. produces 104-ish Bs a day. So now 16% of your market's being exported. Canada produces about 20. We're going to be exporting, call it 2-ish soon, like in the next couple of months. that should more than double over the next couple of years. So that's getting rid of excess product at a time when the marginal cost has grown. Gas today is trading around 3-ish, and the marginal cost of supply we think is 5.
So why are the supply-demand dynamics better for natural gas than oil right now?
Well, you don't have demand uncertainties. So a lot of demand for LNG now is either going to be weather. So hopefully we've got a warm summer for various reasons. One is you consume a lot of gas for air conditioning. And then 2, you've got the build out of LNG. But because inventories are relatively low for natural gas, you need the price of gas to send a market signal to start drilling. We're not seeing that. We've had one of our key producers report this morning. Feedback from service companies has been pretty consistent. You're not seeing a desire to increase drilling yet for natural gas. And so there's a scenario where you'll continue to draw down inventories until you get a price signal. And where we think that price signal is, the valuation of these companies is very attractive. The free cash flow is very attractive.
And we're going to talk about some of those ideas in ProPick, so that's a bit of a teaser. But first, I want to bait you, and I know I'm baiting you in this question, about supply. And, U.S. saying, drill, baby, drill. You said that maybe we can't rely on OPEC to support the markets as well. So at a time when demand is falling and you've got a very motivated government in the U.S. who wants to pump up supply, like how is that not a bigger risk for crude?
Yeah, so drill baby drill is such a distraction, and it's complete idiocy for certain policymakers south of the border to think that they can motivate drilling. So U.S. shale grew at its slowest pace since its inception last year, excluding COVID. Oil averaged around 74. We're 60 today. We're very firm believers, and we've had public disclosure confirm this in the past couple of months even, that shale companies are running out of tier 1 good inventory. And you're seeing that expressed in well productivity falling, the gas to oil ratio. So you drill oil, you produce oil, or you get gas. Well, the amount of gas coming out of the incremental wells growing. So it shows you that these basins are getting more mature. So now at a time when shale companies publicly would say, well, they need 64 to break even. We're 60 today. The strip 6-9 months from now, when you drill a well comes on, you're in the mid 50s. You don't have the economics. You've got an inventory problem. The more you grow, the more you drill, the faster you consume your inventory, which is becoming more and more precious. So our view, Tom, I think will prove us correct. We're in the death zone for U.S. shale growth now. At 60 or lower, production is falling. This notion of drill, baby, drill, we're going to grow 3 million barrels per day, and companies are going to willingly bankrupt themselves. There is no basis in reality for that. And I think a lot of what we hear south of the border, that's a common thread. So we've been very, very public in that view, and I think time will prove us to be correct.
What do you think happens with Canadian production? Maybe politics are in play, maybe those other factors are in play. Yeah. How does that evolve?
It's modest growth. Like we were expecting about 95,000 barrels per day of Canadian production this year. We're still, like with a minority liberal government, C-69, emissions, production cap, time will tell. The uncertainty around pathways, like pathways is this big initiative to become almost carbon neutral or net negative for the incremental barrels. I wouldn't be surprised, and we will see, if Carney comes out to industry in the next couple of months and says, look, I will build you a pipeline because no company is going to step up. And it's of strategic necessity because right now 94% of oil sold to the U.S. It's craziness. So I could see a Carney government saying, we will build you a pipeline, but you get pathways down the path. Like maybe we'll invest a little bit more. Alberta still has to come on board in terms of improving the economics. So I could see that negotiating factor happening. But without pipelines, RBC came out with a good report a couple of days ago. They've got us growing by about 80,000 barrels per day per year to 2030. Demand globally is going to grow pre-tariffs 1 million, 1.2 million. We're up 1.4 million in April. Maybe shave off 500,000 barrels per day from that. So Canada is part of the solution to meeting global oil demand growth going forward. We're just a small part of that.
We've danced around it, but I want to ask you about the risk of an emissions cap. What does that mean for Canadian energy stocks? Like, can you say if the Canadian government goes down this path and puts an emissions cap, what does that mean for the stocks?
I think the headline may be perceived as negative, but the reality is your cash flow doesn't change, right? That's units of volume, which would be capped. So you can't grow. So units of production combined by price, that's very high. What I care about is free cash flow. So that's your cash flow, take away what you have to spend to either grow or keep your production flat. Well, if you can't grow, free cash flow is going up. And the biggest driver of share price performance the past couple of years has been those who have bought back their shares most aggressively have performed the best. So it's a perverted twist where a world where you're constraining production, it's horrendous for our country, our economy. It's brutal. But for share price performance, because those companies would actually have more free cash flow and the ability to buy back more of that stock, it could actually be beneficial. And even at 60, like we've got some names, some oil sand names with 50 years of inventory, they could buy back a third of their stock, even just at 60, 70, which I believe in a year down the road, you could buy back twice that amount.
I want to ask you about a name that comes up so often, like such passionate conviction from non-energy players, but value players, is Canadian Natural Resources.
Right.
Just looking at the valuation, looking at the fact that they have a nice life above $40 per barrel. And I was just looking at your NRG ETF that trades on the TSX, and I don't see it as a holding. Is there a reason for that?
No, I have nothing against CNQ. We sold it a little while ago, like I'm meaning weeks, just to raise cash, just a little. The view is it's hard to be ultra bullish on oil in the very short term because there's too much uncertainty, demand uncertainty, supply uncertainty, OPEC policy uncertainty. We'll get resolution next week. So where do we want to park our money where we still see very attractive opportunity, but we can have higher conviction in the investment thesis? And today it's natural gas. Like you're still relying on Mother Nature to cooperate, but it's the increase in LNG that's been the swing factor. So for CNQ, you get a 6% dividend, you get a exceedingly strong management team, deep resource base. The great thing with us is we can always buy you back tomorrow. So we're waiting for clarity around oil. We've been public in our views that like the meeting next week could present event risk. Now oil's sold off in anticipation, I think, of that. So we're positioned accordingly. We've got 3 oil names. They need $42 to $50 oil to be, going concerns. They're fine, adequate inventory. We're getting paid dividends, still buying back stock, all that stuff. But our focus really today is on natural gas. And so CNQ today, given what we know or don't know, doesn't quite fit.
The meeting next week is
May 5th. So the members of the voluntary deal will come together. And OPEC plus. And they will decide whether they go ahead with returning barrels, and perhaps they will once again accelerate the return of those barrels. And the motivating factor to do so would be to inflict as much pain on cheaters to try to improve their compliance, because really it's been Saudi Arabia that's been shouldering the burden. And my belief is they've lost patience in doing so.
Okay, well, let's get into these pro picks and find some natural gas names. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, now it's time for some of your high conviction ideas, but because you're a returning guest, we can check up on stocks you made just 3 months ago, so I know that your hold period is longer. Varen was one of the names, and actually it's been so resilient. It's done better than oil, it's done better than TSX Energy sector. You picked it on January 21st, and it's up about 6% since then. Do you continue to have conviction in this name, considering you are kind of weaning back your oil exposure?
Yeah. So Varen got bought by Whitecap, or soon to be bought by Whitecap. They got a Competition Bureau approval, so it'd be in the month of May. We liked Varen because we thought the quality of their assets was being massively mispriced by the market. And I think what we believed was corroborated by Whitecap also seeing that, knowing that the timeline for them to act was shortening. So I do think Whitecap drove the bus in terms of timing. I think it validated our view. We don't own it in the fund today because, again, I just wanted a little bit of cash. But we view the pro forma entity where you're roughly $9 billion market cap, you're bigger, hopefully entice more institutional shareholders to come into your stock to lead to a larger trading multiple, because there's no buyers of small caps today. It's non-existent. you're getting probably an 8.4% dividend, sustainable down to roughly 50 to 52.
This is now for the combined.
Correct. Yeah,
okay.
pro forma. You're getting paid on a monthly basis as opposed to quarterly. As a VAR insurer, you're actually getting more. I own it personally for the dividend stream. So yeah, we do like it.
MEG is one people talk about as like maybe a consolidation play as well. That one has been hit a little bit harder, down about 17% since then. What do you do with this?
So it's one of our largest holdings. We only have 12 holdings, real holdings today. So it would be, on public record, it'd be about a 10% weight. It's been sold off on oil weakness and is specifically a Canadian name with max exposure to tariffs, which we haven't really recovered from. We never thought that tariffs would be applied on Canadian energy. It made no sense. There's non-substitutable, highly inflationary, all these different reasons. So I think people sold it on those fears and just haven't come back around to reevaluating it. This would be a name, we hold it because it's got at least 35 years of stay flat inventory, business model sustainable down to 50, returning all free cash, and over the next 5 years at 60. So where we trade today, they could buy back a third of their stock, and at 70, it'd be about 67 to 70% of their shares to be bought back over the next 5 years.
We spoke with American investor Cole Smead of Smead Capital.
Yep.
I don't know if you're familiar with him, but he talked about this idea that it makes no sense for there to be this many energy companies in Canada, and that at 5-10 years, we're looking at, really just a handful because they get bought out or, they buy back their shares so much that maybe they buy themselves. Mm-hmm. And Meg, he said it could be one of those plays. Do you think about that?
I've only been doing this since 2003. My ability to time M&A is very challenged. I like to hold something where I see a disconnect in value, believing that maybe one day somebody like a Whitecap with Verne, they'll see what I see. But given the sell-off in a lot of these stocks, I don't want to wake up to a 20 or 30% headline premium because we see very meaningful upside over, a time frame, not in the next month or whatever, but for some of the names that have been referenced, like we could see a doubling or more, we think, in the share price, because again, it's the ongoing theme of what's the value of that last remaining share or those remaining shares after meaningful share buybacks. We think, given we're bullish on oil beyond the near-term uncertainty, that there's meaningful upside in a lot of these names. You just have to be patient and stick with the volatility. Like my analogy today is we're in a storm. It's like your guy in a rowboat, you're out in the ocean and you see this black wall coming at you. Well, there's nothing you can do. You strap yourself in, you ride it out, and your ability to ride out that storm is predicated on knowing what you own and how strong the value proposition is, the strong sort of the balance sheet, the resource depth, that kind of thing.
And does that apply to Athabasca, which was your third pick, down 14%?
Yeah, so publicly it would be viewed as one of our largest holdings as well. We've got a company with at least 50 years of stay flat inventory. They've got no debt. They have $134 million of net cash on their balance sheet. They're buying back shares with 100% of their free cash flow. Month of March, they bought back 2% of their shares outstanding. At 50, 55, it's basically, they're safe, but it's not exciting. 60 is good. At 70, a name like this really does well.
Now, people might accuse you of being a perma bull in the space, but as you just told us, the way you're adjusting your portfolio, you're raising cash, you're limiting your exposure to oil and gas names, though you maintain positions in some of the ones.
Reducing to oil.
Reducing oil, yeah. But, and then a big chunk now to natural gas, 70% of the portfolio. And names that I see there are Expand, ARC, New Vista. Talk to me about maybe what they have in common and what they, how they can outperform in the sort of the natural gas environment you see playing out.
Yeah. So our view is natural gas is in now a multi-year bull market because you've had enough increase in demand from LNG to minimize the impact of weather. Like if we have a wickedly cold summer and a hot winter, well, the thesis is challenged. But it's that underlying bid every day of liquefaction of, let's say it's going to be 18 to maybe 20 BCF a day. US is growing from 16 to the high 20s. Canada, we're going from 0 to 6 to 8, maybe 8 in the years ahead. And it's then, okay, you see maturity in certain basins. Some areas are bottlenecked from not being able to build pipelines, like in the Marcellus. We think that less shale production growth than the Permian, well, that might mean less natural gas coming out of the Permian as well. So it's, well, where's the marginal basin? And it's the Haynesville, and it happens to be very high cost. We think roughly $5. And that benefit of that marginal cost of the molecule benefits all natural gas companies in North America. And so we want to say, okay, who has the resource depth to have at least 20 plus years to stay flat? Which companies have a market cap size big enough to be relevant to an institutional investor? Because it's helpful to have the institutional investor there because you typically will meaningfully outperform. Who's committing to share buybacks to be able to do that because that buffers your share price in downturns like we're having today. So it's all of those commonalities. In some cases, we get dividends. In other cases, we get meaningful share buybacks. But it's the common thread of multi-year exposure to what should a multi-year bull market for the commodity.
Balance sheets, like we know they're super clean by and large in the energy sector because they got their act together. How would you characterize them on these nat gas plays?
Very, very strong.
All right, well, that's good. Let's end on that concise point. Eric, thanks so much for joining me.
My pleasure.
That's Eric Nuttall of 9 Point. Well, that does it for this show. Thank you to everybody for tuning in. Don't miss our next episode. We've got Meb Faber of Cambria Investment Group. They run about $2.5 billion in actively managed ETFs. He's got a bit more of a value-oriented bent, and he thinks deeply about finance and the markets. He's authored no less than 5 books. He has a podcast and he's pretty prolific on Twitter. This is your opportunity to ask Meb some questions. You know what to do. You can email us at questions@inthemoneypod.com. Find us anywhere on social media at inthemoneypod. And of course, our website, inthemoneypod.com. And we'll see you on the next episode.